Hello everyone, this is Professor Greg here with you with Real Estate Principles, and we're going to be going over chapters 14 and 15 today. I hope everybody had a good holiday during spring break. I know it was pretty crazy with all the news going on, but we're back again in school, and I hope we can come together and do this online to where we have a good discussion, and we do learn, and we can take our test coming up. I actually have our schedule here, and we're going to be marking out March 19th because they went ahead and stopped that class from happening. But now we're going to be doing this for March 26th. We're having chapter 14 and 15 again, types of financing, taxes, and assessments. So we're going to be going over that today. And I think we're going to try to make this just like it was in class. As you can see, you should be able to see my monitor there. We'll be going over all the information and should be pretty fluent with you. Other announcements. We do have our project coming up due, and I went ahead and moved that to April 9th. And April 9th, actually, we're going to go over chapters 16, 17, and 18. So everything's being pushed up a week. So that will be title closing and escrow, real estate leases, and real estate appraisals. So that should be very informative to you. And what we can do is go ahead and start, because there is no roll call. I wish there was. I could see you guys face to face, but all you can do is look at me and bear with me to get through this, and we'll continue on. We're going to start out with chapter 14. So chapter 14 is about adjustable rate mortgages. There's a lot of different mortgages out there that are available, but adjustable rate is very convenient for most people because it's a lower interest rate that you can get into, as long as the interest rate isn't going up, and there's different factors of that happening. It's usually a good stable rate mortgage that you can use for a good period of time. So adjustable rate mortgage, a mortgage on which the interest rate rises and falls with changes in prevailing interest rates. What are we looking for here? So we have the interest rate itself, and this is on page 238. We're going to be going over adjustable rates. The benefit of an adjustable rate mortgage to a borrower is that you can carry an interest rate that is lower than the rate on a fixed rate mortgage of similar maturity. This often makes the difference between being able to qualify for a desired home and not qualifying for it. If market interest rates fall, borrower's monthly payment falls, and everybody is excited about that. But a disadvantage would be if the interest rate rise, the borrower is going to pay more. Now the Federal Reserve just dropped the interest rate down to almost zero interest rate between banks. So what that's going to do is lower the interest rates for adjustable rate mortgages. So a lot of people are going to be getting discounts. It could be, up to maybe $50 to $100 off their payment each month. So that's very exciting for people. But it does show instability in the market when they lower, because they're trying to get kind of a cheaper rate for different banks to lend out money to get the economy going again. So next we have is interest rate. The interest rate, as an index rate moves up or down, so do the borrower's payments when adjustable time arrives with the adjustment. The most popular index is based on an index that includes interest rates of all treasuries and securities, from 3-month bills to 30-year bonds. The index, called a 1-year constant maturity treasury, is published by the Federal Reserve based on daily calculations. So next we have margin. With the margin, The margin is for the lender's cost of doing business, risk of loss on a loan, and profit. Currently, this runs from 2 to 3%, depending on the characteristics of the loan. So it has a mortgage margin with it. You have an adjustment period. This is the amount of time that elapses between adjustments. Its most common adjustment period is 1 year. So that's the adjustment period with the adjustable rate mortgage. Interest rate cap. This is huge. Lenders are now required by federal law to disclose this interest rate gap on how much the interest rate can increase for any one adjustment period during the lifetime of the loan. So that is the cap rate that they have to let you know about. Payment cap. This sets a limit on how much the borrower's monthly payment can increase in any 1 year. Again, payment cap and interest rate cap, they're both caps that they have to let you know with Regulation Z. We'll be talking more about that coming up. Negative amortization. This sometimes happens. Instead of the loan balance dropping each month as the loan payments are made, the balance owed rises. That's not good. This can bring concern to the lender, who can visualize the day the loan balance exceeds the value of the property. So what happens is they'll try to do a re-amortized loan if this happens. And in this situation, it means the monthly payments will be adjusted upward by enough to stop the negative amortization. Next, we have disclosures. Now, everything has to be disclosed, and we talked about that in the prior chapters with Regulation Z. Regulation Z requires creditors to provide consumers with more extensive information about the valuable variable rate featured of the adjustable rate mortgage. Also, the maximum interest rate must be stated as specific amount stated in the manner in which the consumer may easily ascertain the maximum interest rate at the time of entering the obligation. So that's with disclosures with Regulation Z. As you see here, you have an adjustable rate mortgage. So if the interest rate stays pretty much the same, which most of the times there's not big fluctuations in the market, big things happening. Like right now, it's going crazy with everything. The stock market's falling and everything else, so they're trying to lower interest rates. But you see here, you have your monthly payment, and then you have the life of the loan in years. Adjustable rate mortgages go up and down just like a staircase. It all depends on the market, what's going on. Other financing. The number of alternative types of financing continues to expand, including the following options. You have graduated payment mortgage, and we'll talk about that, and that's on page 241. This object is to help borrowers qualify the loans by basing repayment schedules on salary expectations. With this type of mortgage, the interest rate and maturity are fixed, but the monthly payment gradually rises. And they have some examples there on page 241. You have equity sharing. So in return for providing financing, the lender wants to share in some of the benefits normally reserved for the equity holder, called equity sharing. The equity holder would agree to this either to get a lower rate of interest or to get financing when financing was scarce. And that's equity sharing. The next one is rich uncle financing. This is a second variation of equity sharing. This is when an investor may be a parent helping out a son or daughter to buy a home. Quite frequently happens, especially when people are young, first-time home buyers. They don't have a lot of money to put down for closing costs or whatever. So they go ahead and the parents help out. A lot of times they'll just give a gift, but this is like rich uncle financing they're talking about. Giving the parents the right to occupy it. So in this situation, you would be giving your parents the opportunity to occupy it if they want to. and it's legally done. Each party has a right to a portion of any appreciation, as a right to buy the other out at the end of the loan. Then we have package mortgage. Package mortgage, this is possible to include items classed as personal property in a real estate mortgage. This is such items as a refrigerator, clothes washer, or dryer can be pledged along with the house and land in a single mortgage. So it's kind of wrapped up into it, just like a package would be. For the borrower, it offers the opportunity of financing major appliances at the same rate of interest as the real estate itself. It's almost like sometimes with refinance, people will bring all of their different credit cards and other things that they bought, personal property, and they'll refinance it into their home. The next we have other financing continuing, blanket mortgage. So you're just thinking of a big blanket being thrown over everything. A mortgage secured by two or more properties. It's called a blanket mortgage. Suppose you want to buy a house plus the vacant lot next door. I've actually done that before. We were in a subdivision in Franklin area, and it was a brand new subdivision. We bought the house and our property, and they had an empty lot next door that was going to be built upon coming up. So a lot of times it's good to go ahead and purchase a property. Of course, you have to pay the home association loan, home association dues and everything else on the loan each month, just like if there's a house sitting there. But you're able to make a good gain on that property later when you sell it, when somebody wants to build there. So it's a good deal. So the single mortgage will cover both properties, and this actually it is a savings of mortgage interest and also in the closing costs of both properties, because if you do them separate, of course you're going to have two different separate closing costs on that. So the blanket mortgage will do both properties. And also you get better terms if it were financed. If it wasn't financed together, if it was done separately, then the terms might be a little bit higher. It all depends. Then we have a reverse mortgage, next one down. The lender makes up a lump sum payment to the borrower, who in turn repays it through monthly payments to the lender as a reverse mortgage. A lot of elderly people are actually doing reverse mortgages to supplement their income. So again, they say valuable for elderly homeowner who does not want to sell, but whose retirement income is not quite enough for comfortable living. The homeowner receives a monthly check, has full use of the property, and is not required to repay until he or she sells or dies. This actually is sometimes good or bad for the people that are acquiring the estate after they die. It all depends on what interest rate. So it could be a much higher interest rate being charged at that time. So they're paying a whole lot more for that loan that the bank gave them. They're trying to have regulations to keep tight regulations on this, so people don't get hoodwinked later on for a lot more money than the interest rate could have been if they just got a regular loan. Then we have a construction loan, or interim loan they call it. Construction loan, money is advanced as construction takes place. The lender will parcel out the loan as the building is being constructed, always holding a portion until the property is ready for occupancy. Some lenders specialize only in construction loans and do not want to wait 20 or 30 years to be repaid. So if you're going to build a house, you can get a construction loan. They'll come out and inspect what happens after, like if they go and bulldoze the lot and have it all ready. Sometimes that takes $20,000 to $30,000 right off the bat to do so. they'll come out and inspect it. And they say, okay, it is ready for the foundation to be put down. So they'll give another lump sum of money for the foundation to be done. Then they'll come out and inspect that again, and it will be, they'll give another lump sum for the framing to be done. So it just, pancakes all the way up until the end of the construction. So it works out real good. That way the bank has everything inspected, and they make sure that everything is in line, and they're not going to lose money in case people default or whatever else on it, because they know that this has been done so far and it's been inspected. So it's good for both parties. Equity mortgage. We have equity mortgage. Lender agrees to make a loan based on the amount of equity in a borrower's home. This is usually called a HELOC. My wife and I, we did over 1,000 different HELOCs for companies out of California and other states that we went and did notary. And people would take the equity out of their home, and they would get another loan for if they wanted to add on a bathroom or whatever else. Or they wanted to take all their credit cards and combine them into their home loan with a home equity line of credit. The lender agrees to make a loan based on the amount of equity in the borrower's home, generally 70 to 80% of the home value. This is done without having to refinance the loan, and uses the home as an asset against which the homeowner can borrow and repay as needed. So a lot of times a HELOC could be an interest-only home equity line of credit or equity mortgage. So you're only being charged equity while this loan is being done through the life of the loan. So as you pay down the loan, then you're able to put bigger amounts towards the principal instead of paying so much in the interest. Because if you get just a regular loan, conventional loan, a lot of times the interest rate will be higher. And this all depends on the market again. We went over that earlier. The interest rate will go up and down. A lot of times with the interest-only loan, which a lot of people do for the HELOCs or the equity mortgage loan. So it can be good or it can be bad. So some people, if the interest rate gets crazy, like back in the late 70s, they went all the way up to 18% interest. So people were wanting to lock in before that happens with a conventional loan. And then affordable housing loan. We have the one last. This covers many slightly different loans and target first-time home buyers and low to moderate income borrowers. Freddie Mac now offers 2 programs supporting construction of affordable single-family homes in urban centers. One allows builders to cover up to 3% of a borrower's down payment. The second mortgage product benefits builders by reducing some of the economic risk associated with building homes in urban centers. So affordable housing loans usually comes with a government-backed security. Goes in on page 245, goes into Fannie Mae, the HUD program, FHA, Federal Housing Administration, and so on. Again, affordable housing loans. This is an umbrella term that covers many slightly different loans and targeted first-time home buyers and low to moderate income borrowers. So underwriting standards are modified to recognize different forms of credit responsibility. This is pre-purchase home buyer education, and also creates a low down payment for the first-time home buyer. So we have more financing. All kinds of different financing out there. Other developments in mortgage lending include 97% conventional loan. So this is, I go and I talk about this on page 246. One of the most significant developments in mortgage lending has been the introduction of a 3% down payment conventional loan. FIRREA, F-I-R-R-E-A, and the Community Reinvestment Act providing strong incentives for private lenders to engage in affordable housing loans to help lower to middle income home owners. And it's excellent that this came out. If you can get 3% down, a lot of conventional loans are 20% down, because a lot of banks, they want to make sure that they have a little bit of flexibility to take any, if you default on the loan or anything else, they have at least that 20% down that they can work with until they resell the house or whatever else. So it's a little bit better insurance for them. Then you have the Maya program, and this was a corporation that was founded with a $5,000 grant from a local Baptist church in 1994, with the intention of rebuilding parts of Sacramento, California. It has now grown into a national program handling over $150 million a year of loans. It has become the largest down payment assistance program in the United States, and now operates in 4,900 cities in every state except Hawaii. This is usually 1 to 6% of the loan amount, which is wonderful. After closing, the builder, lender, or real estate agent may agree to make a like contribution called a service fee to the pool, and that's how they build up the money back to be able to do more in the future. Then there's seller financing. My parents actually used this back in the 70s. They were doing this. You would actually take over mortgages for people. When a seller is willing to accept part of a property's purchase price in the form of a buyer's promissory note accompanied by a mortgage or deed of trust. So you still have a mortgage and deed of trust on it. That's already implanted. This is where the property has an existing mortgage, like I said, is being assumed by the buyer. When the seller prefers to receive the money spread over a period of time with interest instead of a lump sum cash. So the seller will actually say, okay, well, I'll just give you a higher interest rate, and I'll actually make more money over the long period of the loan instead of getting a lump sum cash. And it worked out best for both parties. So this happened a lot back, especially when I was young, and my parents bought a farm, and they were able to do this with seller financing. And then contract for deed is next. This enables the seller to finance a buyer by permitting him to make a down payment following by monthly payments. However, title remains in the name of the seller. When the final payment is made to the seller, or the property refinanced through an institutional lender, title is conveyed to the buyer. Meanwhile, the seller continues to hold title and is responsible for paying the mortgage. And that's a contract for deed. It's a cute little slide here. Also on 249, they have financing. Other financing tools have emerged over the years, including the following. There's an option. This is used mostly that I know of in commercial. Provides a method by which the need to finance the full price of a property immediately can be postponed. For example, a developer is offered 100 acres of land for a house subdivision, but is not sure that the market will absorb that many houses. The solution is to buy 25 acres outright and take 3 25-acre options at present prices on the remainder. If the houses on the first 25 acres sell promptly, the builder can exercise options to buy the remaining land. And that's an option. It's a wonderful way for people to say, yes, we can go ahead and start this subdivision. We don't know if it's going to really take off or not. We don't know if the market's going to, what the market does. These are all speculations in the future. We really don't know what's going to happen. Just like right now, things are, people really don't know, and the stock market is just going haywire. And builders are, I'm sure, wanting to know what's going to happen, but they have that option to be able to say, let's go ahead and stop right here, sell what we have on the land, and then we still have that option that we can go ahead and use in the future. So it could work out good for everybody. Then rental. So many people out there these days are deciding to rent instead of buy. So the large corporations, especially after the downturn of the housing crisis, these corporations got together and they bought up all these homes that were in foreclosure. And they said, okay, we're going to fix them up, we're going to keep them in a big pool, and we're going to rent them out. So bunches and bunches of homes in the major cities are owned by these corporations, and they're actually renting all of them out. So rental, even though tenants do not acquire fee ownership, which is real ownership, rentals and leases are means of financing real estate. Leasing is an ideal method of financing when the tenant does not want to buy, cannot raise the funds to buy, or prefers to invest available funds elsewhere. My grandfather always wanted to rent. He never wanted to own. He didn't want a house to be able to keep him tied down any one place. So he went ahead and rented, and he never bought a home. It was interesting because I'm in real estate myself. I can't see how he would want to be that way, but he never wanted the, with a home comes a lot of just, you really have to know how to take care of the home and keep everything up, and there's a lot of responsibility with it, and a lot of people don't want it. I said, no, I want to live a little bit more fancy-free, and if I want to move next week or whatever else, I'll tell my landlord, and I can go and rent something else somewhere else in another city without having to put the house up for sale and all the other stuff, as you know. So, land leases is next. That's actually common throughout the United States for both commercial and industrial users and for farmers. Homes built on leased land are commonplace. Typically, these leases are at least 55 years in length and bearing an agreement to the contrary, the improvement to the land becomes the property of the fee owner at the end of the lease. So the land always stays with the person that owns it in the first place. They lease out the land for somebody to build the property, and they own the home, but the original owner still owns the land. It happens a lot down in Florida. A lot of the retirement homes down there are on leased land. You own the structure itself, but the land stays with the owner previously. It's known all over that they do this. If you look at London, England, almost every property in London is owned by the Queen, the royal family, at least large sections of it, and they lease it out to people for up to 100 years at a time. So people just lease the land. They don't own it because it can always be taken back, but it is an agreement where it is leased up to 100 years. So it's a pretty neat situation about land leases. Now we have the key terms here, the adjustable rate mortgages, as we talked about, blanket mortgage, construction loans, equity sharing, there's graduated payments, negative amortization options out there, package mortgage, RAM, and then seller financing. Just make sure you know all the key terms, like before in the prior tests we go over. The review questions here on page 252, we can go ahead and go over the first 5 like we usually do in class. Number 1, in order to make adjustable rate mortgage loans more attractive to borrowers, lenders offer, so A is lower initial interest rates, B, gifts such as appliances, trips, etc., C, lower insurance rates, and then D, lower down payments. And actually it's A, they offer lower initial interest rates. Number 2, prior to the introduction of adjustable rate mortgage, the FHLBB approved the use of, and that's actually both. That's C, the variable rate mortgages and also renegotiation rate mortgages. They talk a lot about the FHLBB in paragraphs prior. Number 3, when considering an ARM loan, the lender must explain to the borrower in writing, and that's actually D, respective credit report with Regulation C also. It all has to be out there in the public. Number 4, equity sharing is based on the concept of someone who has assets sharing those assets in exchange for, and it's both A and B, a share of the ownership and also the tax benefits. So that's C. Then number 5, we have when an existing loan at a loan interest rate is refinanced by a new loan at an interest rate between the current market rate and the rate of the old loan, the result is it's a blended loan. It's B, blended loan. So we have 6 through 11, if you guys can do those for homework and go over all those. As you know, the test coming up, we'll have similar questions on those, and I'll try to stick with that as close as possible on the test. Next we have chapter 15. So let me go to chapter 15 here. And what we're going to do for attendance is that I'm going to give you a word for the attendance. So whenever I put this out there, I'm going to say, what is that word for the attendance? I'll email you, and then you email me that word back. So while I'm showing you the slides and everything else, I'm going to say a word. So like for chapter 14, we would say that this is just a word that I might use. I'm not saying it is. So I can say adjustable, and you would have to actually see this video to know that I said the word is adjustable. So whenever I email you and say, did you watch the video, or for your attendance, you say yes, adjustable, and that way I'll know that yes, you watched the video. So that's how I'm going to do the attendance coming up. So it kind of makes it fun and interesting. So let me pick out a word for chapter 14, and I'm going to go ahead and say equity. So whenever I ask for your attendance coming up for chapter 14, we have equity, and I'm going to actually write that down and make sure that I have that for later. So just remember equity, chapter 14. Okay? So let's go to chapter 15. Okay, taxes and assessments. So we go over here, chapter 15. That one. So, chapter 15, and this is on page 255. So we're going to talk about property taxes and assessments. Everybody has property taxes. There's two sureties of life that are going to happen. You're assured to pay taxes, and you're assured to die. So there's two main things. So we're talking about property taxes this time. Important terms and considerations regarding property taxes include the following: budget and appropriation. So on 256, we talk about budget and appropriation. Each taxing body with the authority to tax prepares its budget for the coming year. Each budget, along with a list of sources from which the money will be derived, is enacted into law. Appropriation process. This estimates sales taxes and state and federal revenue sharing. Business licenses and city income taxes are subtracted from the budget. So that's budget and appropriation. Appraisal and assessment. This is a big part of what the tax department does, is assess properties. State assessor's office applies each taxable parcel, land, and improvements therein. Appraisal's procedures vary from state to state. The value is estimated fair market value of the property, and the appraised value is converted into an assessed value upon which taxes are based. That's how they actually base the taxes on that. So that's appraisal and assessment of property with the tax assessors. Ad valorem taxes. This is taxes that are levied according to value. We have source of income. That is a huge source of income for the local government. We have the tax district appraises all taxable property, and that happens, it depends on the areas. It could be every so many years that they reassess and they go through. If there's a lot going on in the city, they might assess even sooner. But we'll talk about here coming up how they will actually use real estate people to let them know if properties increase at a certain amount that they might need to reassess. Tax rate calculation we have there. The assessed values of all properties subject to property taxation are added together in order to calculate the tax rate. This levy or tax can be expressed three ways. Number one, as a mill rate. Number two, as dollars per hundred. Or three, as dollars per thousand. All three rating methods are found in the United States. As a mill rate, this tax rate is expressed as mills per dollar of assessed valuation. Because 1 mil equals 1/10 of a cent. So that a 4-cent tax rate is the same as 40 mils. Okay, we're going to see that in the graph coming up. So here you see calculation using mils. You have 85 mils, so you just move the decimal point over to 0.085. Okay, you have the 215 mils, then that'd be 2.15. Okay, so you just move decimal point 2 points over. You have 5 mils, and that equals 0.005. And then you have the result of the tax bill. It's the tax appraised value, assessed value, and millage rate on that. So we have many different other taxing matters. Other taxing matters include unpaid property taxes. And here on page 257, unpaid property taxes. If you own real estate and fail to pay property taxes, you will lose the property. In some states, title to delinquent property is transferred to the country or county or state. So if you don't pay your taxes, it will go back to the state. A redemption period follows. So you can redeem the property. The owner or any lien holder can redeem the property by paying back taxes and penalties. If redemption does not occur, the property is sold at a public announced auction, and the highest bidder receives a tax deed. Okay, so the purchaser is entitled to a deed. All right, but this is only if the prior owner does not step forward and redeem it during the redemption period that follows. If it is redeemed, the purchaser receives the money back plus interest. So if you go to a tax auction and you buy a piece of property, and a lot of times here in Tennessee, they'll give a year, which is a long time, for the current owner that didn't pay the taxes to go ahead and pay the taxes up in case they want to. Well, you got to hold that property. So even if you're an investor, you say, well, I can't really build anything on that property or fix the property up for a whole year because they might come back and buy it back. Not buy it back, but actually pay the taxes on it and get the property back. But still, at these tax sales, you can get the property at such a reduced price that it actually is worth to a lot of people that have good amounts of money to purchase the land and just sit on it for a year and see. A lot of times people never come up and they get really discounted land. They go ahead and put all the money back into the property to fix it up, put it back on the market, and then make tens of thousands of dollars. It's there's some that over $100,000 sometimes. It's really something. It's a good way of doing real estate, but it actually, you do have to wait in between periods. So, assessment appeal is the next one. So by law, assessment procedures must be uniformly applied to all properties within a taxing jurisdiction. An owner who feels overassessed can file an appeal before an assessment appeal board. Note that the appeal process deals only with the methods of assessment and not taxation, not with the tax rate or the amount of tax. But if you have a house and so let's say Nashville just got reassessed and they had all these big homes built, which they're doing right now. They're leveling out different ranches, different smaller homes, and they're building a huge huge home on that property. But when they come to reassess the whole area, well, now they have all of these homes that have been built, and the assessment is going to be higher. So these people that still have these ranches that are there in that area, their property tax just went way up because of all these other homes that are built. And they're saying, hey, wait a minute, that's not fair. What's the deal with this? So what they do, they go to the assessment appeal board and they say, hey, don't make my property that much higher because my house is not worth that as much as those other houses because they're brand new and all this other stuff. So you can actually go and appeal, and they can lower your assessment on your house, which lowers the amount of tax that you're going to have to pay each year on your house. That happens quite frequently. A lot of people get up in arms when they get reassessed, and it's so much more than what they think it should be. So then we have property tax exemptions. More than half the land in many cities and counties is exempt from real property taxation. This is because governments and their agencies do not tax themselves or each other. Why would the government tax each other, right? The property tax exemptions are used to attract industries. So they say, okay, we're not going to tax, please move into this area. And Nashville's done that with all different industry. Try to build up just what they do, they just say, okay, you don't have to pay any taxes for 10 years. So Nissan moved into Cool Springs, same deal. They say, oh man, I don't have to pay tax there for land or building or anything else. But it brings all these jobs to the area. And that's what helps out the growth of an area. So they don't have to be taxed, they move in. We have property tax variations. Property taxes on similar priced homes within a city or county can be widely, when price change faster than assessor's office can reappraise. Okay, this is what I was talking about before. So property taxes on similar price homes within a city or county can vary widely. So they can be a lot different. When prices change faster than an assessor's office can reappraise. As an aid to keep current on property values changing, states are enacting laws that require a real estate buyer to advise the assessor's office of the price and terms of the purchase within 90 days after taking title. So that way the assessor will know that they paid this amount more for the property or less of the property, and that way they'll have something to go by when they reassess the area. Very good, because tax assessors can't keep up with everything, and this is a good way that they can do so. Then we have special assessments. Often the need arises to make local municipal improvements such as paving of a street in a certain area. This will benefit property owners within a limited area. The area receiving the benefit of an improvement is the improvement district or assessment district. Okay? And the property within the district bears the cost of the improvement. So if they come and do a lot of improvements around your area that you're going to be benefiting from, then they can go ahead and reassess your property and get you to pay more taxes to try to pay for that improvement. That's what they've been doing in Nashville when they build a big stadium. Everybody's property values increase because of that thing that they built in that area. Well, they're going to reassess, and they're going to try to get some of those taxes to pay for the roads that they built around the stadium and all those stuff. So that's what they do. So with federal income tax, there's a basis, and it's page 262, calculating the home basis. Basis is the price originally paid for the property, plus any fees paid for closing and improvements used in calculating income taxes. Here they say on page 262 again, if the home was built rather than purchased, the basis is the cost of land plus the cost of construction, such as the cost of materials. Labor. The value of labor contributed by the homeowner and free labor from friends and relatives cannot be added to it. So that's your basis there. So, we have a calculation of gain of sale, or property gain, or income gain. So they have a home there for $200,000, closing cost for $1,500. Okay, so you see the basis is $201,500 on that. You add the landscaping, the fencing for $10,000. Okay, these are improvements you put into the land. Brings it up to $211,500. Add a bedroom and bathroom for $45,000. So that brings it up to $256,500. All right. You see this on HGTV all the time. They have all this broken up of what they put into the home after they bought it, and then they're going to put it right back on the market, and they're going to sell it. And then they're going to get a capital gain set out of this. Okay. So you sell the home for $325,000. Sales commission, closing costs are $26,000. So you got to add that in, subtract it in, and then you have calculation of gain. So you see there, amount realized $299,000. All right, amount realized again, and then less basis of the $256,500. Your equal gain is $42,500. Now, if this is a personal home, which you're going to see, and you live there for at least 2 years, then you don't have to pay any taxes on that. But if this is just an investment deal, and it's not your primary home, then you would have to pay capital gains tax on the $42,500. It's usually, it depends on how long you have the home also. It's less if you have it for a year, but usually it's around 28% capital gains tax on that. But that fluctuates. The whole market fluctuates, so that'll fluctuate also. Income tax exclusion. An income tax exclusion is a special rule that applies for a taxpayer when, we were talking about this just a minute ago, there's a sale of principal residence, okay, your principal home that you live in, used for 2 of the last 5 years. Okay. Married, you can exclude up to $500,000 in capital gains. That's wonderful. Or if you're single, you can exclude up to $250,000 in gains. So if your house appreciates and you built whatever in your house and it appreciates up to $500,000, then you don't pay any tax on that, and that's a huge amount. Just take 28% times 500,000, and that's what your taxable gain would be that you would have to give the government. Here with the married, it's excluded. You don't have to do that. This is a huge loophole that a lot of government officials want to change to where the government would actually get paid that capital gains tax. But right now, it's still in law that this is the exclusions, and hopefully it stays this way, because that's one way that a lot of people gain a lot of going up the stair of from the middle class to the upper class to going all the way up with real estate. It's one of the main things a lot of people will use to just go that stair step and get a bigger house, and then a bigger house and a bigger house, and then make more money in the future. So capital gains tax rate. The Tax Cuts and Jobs Act of 2017, which wasn't that long ago, reduced capital gains tax for joint filing taxpayers too. So for those with incomes up to $77,000, it's 0%. There's 15% of capital gains for those incomes up to $479,000. So actually it's gone down with capital gains since I heard before. Then there's 20% for those with incomes over $479,000. So still, capital gains isn't too high up there. It's affordable, especially if you're making a good amount on your sale. You can still laugh your way all the way to the bank to pay the capital gains on it. We have installment method. This is on page 265. The installment method is the sale of real estate in which the proceeds of the sale are deferred beyond the year of sale. So if you sell by the installment method, that is, you sell property at a gain in one taxable year and receive one or more payments in later taxable years, the installment method of reporting is actually automatically applied. If this is not suitable, you can elect to pay the taxes in the year of sale. The installment method is only available to those who are not dealers of real property. All dealers in real property are required to pay all the taxable taxes in the year of the sale. Tax deductions. The Internal Revenue Code provides for the deductibility of state and local real estate taxes up to $10,000, which is good. Capital gains. This is amount realized, the selling price of the home, less selling expenses. Okay, we talked about that before. Gain on the sale. To calculate the gain you must subtract the selling expenses from the sale price, and then subtract the basis to determine the gain. And that's what you pay your monthly, your amount for capital gains on. Tax rules for real estate and continually are changing. Because tax rules for real estate are continually changing, there is a high impact on real estate, the need for more frequent and detailed information, agents' liability for tax advice. Then we have our key terms at the end of chapter 15. Before we go any further, I'd like to tell you that for attendance, the code word for chapter 15 is installment. So whenever I ask you the key words for chapter 14 and 15, you're going to say chapter 14 is equity, and then chapter 15 is installment. Okay? That way I'll know that you guys have watched the video. So our key terms again: ad valorem, taxes, adjusted basis, assessed value, the assessment appeal board, we talked about that, basis, documentary taxes, installment method, the mill rate, tax certificate, and tax lien. Now we have the review questions, which I'll go over the first 5 with you, and then if you could do the rest on your own on your time. So number 1, local government programs and services are financed primarily through, and it's going to be A, property taxes. Number 2, taxes on real property are levied, and it says both A and B on an ad valorem basis according to the value of the property B. So it's C, A, and B on that. Number 3, the assessment ratio of real property in a community may be, and that's A, 100% of its appraised value. Number 4, which of the following properties has the highest asset value? And they give you all these different ones there to look at, and it's A, market value $75,000, assessed at 75% of the value. And number 5, tax rates may be expressed as, and that's all the above, A, B, C, and D. All the above on that. So if you guys can go ahead and do the rest of these questions, and as you know, you will see them on the test coming up. We're looking at, again, we were out March 19th, so we're moving the test to April 2nd, and then moving the project from April 2nd over down to April 9th. On April 9th, we're going to be doing the test 3, okay? We're going to be turning the project on April 9th, and also doing chapters 16, 17, and 18, okay? So I'll let you know that by email too, what's coming up. And then we'll be back on our regular time for our syllabus. So everybody will know in the future we're back without that 1 week that we had missing. So we'll be back and rocking and rolling. Other than that, I have just that we went over today, chapter 14 and 15 again. And we'll have the test next time. And just remember those 2 for your saying that you actually watched the video, which is chapter 14 is equity and chapter 15 is installment. So I'm repeating that again because in the future I'm just going to say it once what code word is for each chapter. So that way you'll know. I just hope everybody stays safe and healthy, and just please know that we'll all be together here soon again, and appreciate you watching, and we'll be talking to you soon.